Hello everybody, welcome to another session for the CISI Level 2 Fundamentals of Financial Services qualification. We're up to session or lesson number 15, which is continuing the bonds theme, so chapter 5 of the workbook. We're going to be looking at bond security, investing and leverage. So first of all, what I'd like to do is welcome our guest for the video. Just to introduce Arjun Bhandari. Hello Arjun, how are you?
I'm good, thanks, Matt. How are you?
Good, not too bad, thank you. Not too bad. And Arjun is an associate portfolio manager at Janus Henderson Investors. So, Arjun, could you tell us a bit about Janus Henderson, what you do in your role, and how you got to where you are?
Yeah, of course. So, Janus Henderson is a pretty large asset management company. So we merged with a Henderson, the UK company, merged with Janus, the US company, a few years ago, and as a result, we're kind of like one of the top or biggest asset managers in the world. We've got 380 billion odds, I think, in AUM. I specifically work for the strategic fixed income team within Janus Henderson. It's a relatively small UK-based team. We've got assets under management of about $10 billion. We sell essentially bond funds across the globe, generally focusing on more developed markets and more kind of safe investments rather than anything too hairy or risky. So I joined Henderson about 10 years ago on the trainee scheme. I initially just kind of straight out of university, applied to a bunch of companies. I must have got, a dozen rejections or so before I found this scheme, one-year scheme that I got onto. As a result, I was placed in a few different areas amongst the organization. And after a year, I applied to a job within this team and on this desk, and I was successful. And I've been there for, pretty much almost 11 years now. So yeah, a long haul and great company to work for and great people. So enjoying it.
Oh, fantastic. And what, Arjun, did you joined on a grad scheme, did you say, straight from uni?
So Janus Henderson has a couple of different schemes to get young people into the company. One of those is a graduate scheme, but the graduate scheme is slightly smaller base. So we only take in kind of four or five people every year or two on that. The trainee scheme is much more regular in that we get probably between 10 and 12 young people in, used to be every quarter, pretty almost, just for a one-year contract to show them what working in the organization is like, to expose them to different business functions. And also a lot of them have been retained and a lot of them have stayed on. So it's been really good for the organization just to get a bunch of kind of younger people in, and it's really good for the environment. I have done all of the qualifications and stuff like that, which if you're kind of interested in this industry, I think it's always good to kind of look into those things and know what that's about, the CFA, the IMC and those kinds of things as well. So those are also good parts in.
I might add the CISI into that as well there, Arjun.
CISI, of course, yeah.
just to toe the party line there. So thanks very much for introducing yourself, and it's really good to have you as one of the sponsors and our kind of subject matter expert, if you like, for this session. So I just want to before we get into the session, just want to introduce what we are going to be focusing on. So as I said, this session finishes off the bonds chapter, but we are going to be looking at the advantages and disadvantages of investing in bonds, which we'll come to second. We're going to look specifically at security, and we are going to look at the role that credit rating agencies play in that. And we're also going to be looking at the concept of leverage in a company's financial structure. So we're going to be talking about how debt and equity can be used together and the impact that has on shareholders in different circumstances. So that's what we're going to focus on here. So the first thing that we're going to look at, and the kind of first question, if you like, for Arjun, is I've just mentioned security there, and we've actually, as a group of students studying this qualification, we've come across security previously when we've looked at things like unsecured and secured borrowing, when we'll be looking at ways that you can borrow money. And we've often used mortgages as an example of secured borrowing and unsecured. So when we say security, what do we mean by that in terms of bonds?
Sure. So I think first thing to note, first and foremost, is that bondholders, or debtors, as I might call them, are top of the capital structure. So a organization has, it's made up of a bunch of different capital, as we'll get to later, the mix of debt and equity, etc. But in the event of anything going wrong with the company, or it winding up, or being in default or insolvent, bondholders will always be top of or mostly always will be top of the pecking order in getting any kind of proceeds from the business or from it winding up. Equity owners are usually bottom of that list, who are waiting to get what is kind of left over. That can be enhanced in a number of different ways that I guess we'll talk about on this slide, in terms of different guarantees that we can have on these bonds. So we can get first party guarantees, second party guarantees, and third party guarantees, for example. These will essentially provide different sets of kind of assurance to bondholders. So you can get third party guarantees, which are essentially a third party company insuring a bond against a default. So that's a pretty simple kind of contract. You enter into an agreement with another company and you say, okay, I'm buying this bond. If it defaults, you will kind of pay me my money back, and that kind of creates less risk involved in that. Of course, it has a cost associated, which doesn't make it always the most attractive option.
So that Arjun is the third party guarantee that we've got up on the slide there. That's what you're referring to there, is it? And what I've got up there about the types of organisations that might provide that kind of insurance. Are we talking about? We're talking about potentially banks or insurance companies? Are we talking about things like that might also provide that security?
Sure, more the latter, and more kind of specialist companies as well. To be honest, it's not something that we use on a regular basis within our funds, or within generally within kind of the investment world or the mutual fund world. It's not, again, due to the costs involved, it's not the most optimal solution. Fixed charges are pretty common with bonds. Bonds are usually backed up by a lot of documentation, which can run, hundreds of pages, detailing all sorts of kind of assets that the company has and that you might have recourse to in the event of a default or something going wrong with the bond. So that kind of provides you a little bit of security, knowing that, okay, if WeWork goes out of business, maybe the building that they own will become ours because we can claim it as part of that fixed charge kind of asset security. One thing also that's not on this slide, but which is really important for us bondholders, is covenants, which encourages good behavior and good governance from companies. So covenants are something that are written into the bond contracts. And essentially they say, this company will not behave irresponsibly. It will not take on too much debt. It will not, management will act in appropriate ways. And you have all of these different kind of legal kind of contracts saying or holding the company to these various covenants. And if those are broken, you again have recourse to claiming some of those assets, or claiming or filing suits against the company.
Right. Okay. So there's legal recourse if they don't abide by those covenants. So we're kind of almost talking about a list of rules that the bond issuer has to abide by in order to kind of not find themselves in court.
And it can be really complex, to be honest. At times, like you get a bond offering from, say, Virgin Media, and it will have an associated 200-page document, which I don't know how some people kind of comprehend it without a law degree, because it's like, there's so much legalese and so many different structures and organizations involved. It can be very hard sometimes to understand exactly what your protections are and what they aren't. So it's really important to look through those documents carefully, or as we'll get to later, you have other agencies and other third-party organizations who do that for you and kind of give you information around that.
Yeah, thank you. So to kind of summarize what Arjun just spoken about there. So when we're talking about security, we're talking about that almost guarantee that the bondholder will get their money back, even if something derogatory happens to the bond issuer. So if the company potentially goes out of business, bondholders can have some element of guarantee that they will get their money back if that's the case. And as Arjun's been talking about, you've got different types of security that might be offered against the bond. So Arjun's spoken about the third-party guarantee, the fact that another organisation or a third party can guarantee to repay that. Although, as Arjun said, in reality, you don't see many of these, certainly in the line of work that Arjun's involved in as well. But then you've also got things like fixed charges, which are these specific assets that might be perhaps factories or offices or something like that, a building or something of that nature that's provided a security against that bond. So that, again, these assets would be sold and that money would be repaid to the bondholders. And then we've got floating charges up there, which are kind of general assets, which might be stock and things like that could be sold. And I kind of think the fixed charge and floating charge are almost, to me, a little bit like fixed and current assets. Your fixed assets are going to be more difficult to turn into cash. They're going to be your bigger things that might take longer to sell. Your floating charges might be the things that are more liquid and easier to turn into money more quickly. And then, as Arjun spoke about, you also have these other things which aren't on the slide here and aren't spoken about in the workbook, but these covenants, which are these kind of rules that the bond issuers need to abide by, almost like a charter, isn't it? It sounds like, you will do this and you will do that, abide by this. And that's kind of how that works. And interesting. Do you come across covenants quite a lot, Arjun, in what you do?
Yes, I mean, they're very important to hold kind of an organization to account for what they do. I mean, if I invest in a company which has 100 million of debt, for example, I can say, okay, I know their revenue streams, I know their cash flows. I think, they will have the ability to pay me back at the end of the period. If that company then decides to, borrow another £1 billion on top of that, I have less confidence in them. I have less, faith that they're going to repay back my money. I need to have these assurances written into the contract that these companies are not going to go and do this kind of illicit or, behavior which doesn't benefit debt holders. And I think a lot of the time you get a bit of a struggle between, debt holders who often preach kind of more prudence and equity holders who often kind of, want the companies to take more risks and be more expand at faster rates and everything like that. So often you do get this push and pull between the two sets of investors as well.
Yeah, it's that the financial returns must be playing a big part in the motivation so equity, those shareholders want more risk to be taken because they want their share prices to go up and they potentially want more dividends at some point. So yeah, it's an interesting one, isn't it? The dilemma that you find, the different dilemmas that you find there. Okay, that's great. So we've spoken about.
Lastly, Matt, sorry, on this slide, I just wanted to point out the concept of recovery rate. So when we're saying that if something goes wrong with the bond and you'll get your money back, we're not necessarily saying you're going to get 100% of your money back. Nothing is risk-free or nothing is guaranteed in life. You're depending on the riskiness of the bond. Again, something we'll get into later, the investment grade and high yield distinction. These bonds often have different recovery rates. So for a safer bond, for example, a big, company that's backed by a lot of cash and floating charges and fixed charges, you might get 80, 90% of your money back. For more risky companies with less of these things and higher debt loads, you might be getting 30-40% of your money back. So that is also something to keep in mind, that these guarantees, aside from third-party guarantees, are very rarely going to pay out 100% of your obligation.
Sure. Yeah, interesting. Yeah, I mean, but still, even if you got 60-70% of it back, it's probably more than shareholders would probably get back from, depending on how much money left. So yeah, absolutely. So like you say, it's never risk free. There's always that chance that even if there is security against these bonds, that you're not necessarily going to get 100% of your money back. Yeah, it's a really good point. Really good point indeed. Excellent. Right. So that's kind of the basics around security there. So moving on to one of the other points that we said that we'd cover off is something that's closely linked, which is around credit rating agencies. Now, Arjun, can you tell us a little bit about what a credit rating agency is and what it does?
Sure. These are kind of huge independent organizations. Companies will retain them to rate their bond offerings. As you've shown in the slide, the main ones are Moody's, S&P, and Fitch. Moody's and S&P probably the two biggest, and Fitch just behind. All of them have a similar kind of scale when rating a bond. But I guess, so to kind of take a step back, what they will do is have a look at a company. They will look at the financials of the company. They will look at the balance sheet, the cash flow, the industry challenges, the industry opportunities. They will meet with management, and they will kind of do a lot of due diligence around a company and specifically the bond offering. Because as we said before, each bond offering comes with these like huge documents, which can vary quite a lot, even within a company. I gave the example of Virgin Media before. You might have 3 different bonds issued by Virgin Media with 3 pretty different risk profiles when you come down to it, and they actually might be rated differently. So it's important for these companies to kind of look at, it's important for these rating agencies to look at the companies more holistically, but also the individual bond issue, and dig into specifically the risks that it presents. So you've got here, you've shown the kind of scale of the ratings, and AAA is kind of seen as the golden guarantee. Pretty much as much as I said nothing is guaranteed, AAA is as close as to guaranteed as you can get. It's the US government are going to be raised to AAA, or these big governments and these big kind of multinational companies like Apple and those kinds, Google, and these kinds of people with like tons of cash on their balance sheets, very little risk to their business models going forwards, a lot of kind of structural growth opportunities and moats that they have. These companies are seen as kind of like, gold-plated, like very easy, safe investments. You kind of go down the scale onto triple B. Triple B is kind of just that one notch above high yield. So you've got, so I mean, here we've called it investment grade and non-investment grade. Non-investment grade is also referred to as high yield bonds. It's also referred to as junk bonds. They've got a lot of names and a lot of different kind of risk profiles within them as well. Triple B, double B is a kind of probably the biggest space to be in, and I think it's a big kind of crossover space between these two kind of distinctions between investment grade and high yield. Why that's important is the cost of capital with these ratings changes quite a lot. So, a AAA bond, if I am Apple, I can issue a £500 million bond with a 1% interest rate. So, I will only have to pay £5 million in interest a year because I'm seen and rated as a safe investment by these credit rating agencies. If I'm a more risky company, let's say House of Fraser, for example, the UK high street brand, who have had a lot of challenges in their business and a lot of kind of competition, and of course, like, you know, the decline of the retail market, they might be rated triple C. As a result, if they want to issue money, if they want to issue bonds and borrow money, they will have to pay probably, you know, 6-7% on that. So 100 million bond will cost them £6 or £7 million a year in kind of interest. So what these agencies rate companies is actually very, very, very important in terms of their cost of capital and their interest costs on a yearly basis.
So again, it goes back to, oh, sorry, I was just saying, it goes back to the concept of risk and reward, doesn't it? And you know, the higher the risk, the higher the potential reward would need to be for an investor to consider it. And it would cost, as you were saying there, you know, if someone's triple C rated, the bond is going to have a higher coupon rate because they're seen as being riskier to invest in, and therefore the investor needs to be compensated for that potential risk.
Correct, and I think you know, it's important to use these rating agencies as a guideline, and I think, you know, a lot of the major, it is so widely used, it's kind of become ubiquitous with bond investing. So it's something that we look at and we will follow, but to be honest, it doesn't mean that you kind of look at these ratings and you kind of rest on your laurels and you say, okay, that's rated triple B, it's investment grade, it's going to be safe. There is a lot of work also that needs to be done by ourselves, kind of to enhance the work done by these rating agencies, to kind of say, okay, you know, this is how they view it, but we think the world is going this way and we think this might happen to this company. Because of course, like, you know, when you're on the precipice of triple B, moving down to double B can be quite a big interest cost, and it can cause quite a lot of trouble for the company at times. And as such, you want to be ahead of these rating agencies. You don't want to be following them, which I think is a really important point. Rating agencies will kind of conduct quarterly reviews and certainly annual reviews, which they might change ratings. So it's important to kind of keep your own due diligence going and use rating agencies as a guideline or a kind of categorization tool more than anything, I would say.
Yeah, sure. So
there's a lot of other.
Sorry, Arjun, I interrupted you there.
No, I was just going to say there's a lot of other third-party companies who have kind of become almost the next level of rating agencies and looking really, really deeply down into some of those fundamental aspects that we were talking about. So, you know, we might subscribe to those guys as well, who might be able to give us a lead on when they anticipate these ratings might change. Right.
Interesting. Right. Okay. So there are other organisations out there that offer something similar, but a different or a more detailed look at some of this stuff. But it's interesting that you say that you can't just rely on these, that there's work that has to be done to kind of dig a bit deeper. Interesting that happens. And I think, if I recall, during the financial crisis, these credit rating agencies came under some flack because of the ratings that they provided for some of these asset or mortgage-backed securities that caused some of the subprime problems.
Certainly, like some of those CLOs, I won't get into CLOs at the moment. I think it might be a bit too technical, but yeah, I mean, they were rated AAA, and you know, as I said, if you're following what these rating agencies say, you're stuffed, because you know you thought you were holding a guaranteed security and essentially you've been left with nothing. So they are a very important aspect of bond investing, and they are very important at kind of holding these companies to account as well, because of course companies want to maintain or improve the rating that they have when they can, because it will make borrowing money and accessing capital markets cheaper for them. So it is a very important aspect of it, but as you're kind of saying, it's not something to be relied on solely.
No, sure. And I suppose in many respects, it's a bit like an individual's credit history, isn't it? It's a bit like kind of, you know, where you've been and where you're going, and that it kind of it gives you for a point in time where that government or that company actually sits, bearing in mind. So it's a bit like our personal credit history and how expensive therefore it's going to be for me to take out a mortgage or a personal loan based on my reputation for repaying debt in the past and other things that might come into play, like the way I spend my money. And if you've taken out a mortgage, they look at all sorts now when you take out your mortgage. They look at your bank statements to see how you're managing your money. Do you have money left? So it's a similar thing, isn't it? But for governments and for companies.
And just to kind of point out, there's nothing inherently wrong with being a low rating. So some companies may choose to run their business really punctually. They may choose to run it with high levels of debt, low levels of equity, and just say, we think this company is going to grow super fast. We just, we're willing to kind of put a lot of risk on there because, we think it's justified. And there are bond strategies that will, solely invest in those riskier or, worse rated parts of the market because the returns are so much higher as well. So our sweet spot, our kind of like place we like to be is the triple B, double B space, because we think it provides a good trade-off between risk and rewards. However, some managers will focus just on that AAA, AA bit, and their mandate is to give you a 2% return a year, and they can do that pretty easily using those credit ratings and those securities with those credit ratings. Whereas a triple C bond manager might be saying, okay, House of Fraser bonds are looking like they might go into default, and they're trading at 50 pence on the pound. I'm going to take a risk and I'm going to buy them because I think the recovery rate, as we were talking about earlier, might be 80%. Or I think, someone will come in and rescue this company and it will be recapitalized and the price may go up 30, 40%. So within bond investing as well, despite it not being as risky as equity investing, you do get these, distinctions between the risk profiles in strategies that can be run.
Yeah, of course. Yeah, absolutely. Yeah, indeed. It's not as straightforward as bonds are less risky than equities. It's, as you say, within the bond arena, you will have kind of different levels of that. Absolutely great. Excellent. Thanks so much for that, Arjun. I really, really appreciate it. And I'm conscious that you're giving us so much information here, so I'm going to give you a little bit of a break.
I've tried to listen. I noticed that as well.
So we've spoken about security, we've spoken about credit rating agencies. So we also want to look at kind of giving a summary or concluding piece around the advantages and disadvantages of investing in bonds for investors. And Arjun, if there's anything that you want to add to any of this, anything that you want to bring in, then please do just talk about it and speak up. So okay, so in terms of advantages for those investing in bonds, I mean, Arjun there was talking about kind of that comparison with equities, which is quite an interesting one. But there's a number of advantages that if you cast your mind back to some of the things that we've looked at that come with bonds, especially if you're comparing them with other investments. But the first is that obviously you get this regular and certain, well, hopefully certain flow of income. So the fact that you will receive the nominal value back on the date stated, as long as nothing too badly goes wrong with the company or the government that you purchased the bond from, you should get those cash flows, those regular cash flows, like your coupon payments every 6 months, hopefully, and you will get your nominal value back. So some of the uncertainty that you get with investing in shares, you don't know whether the share price is going to go up or even go down compared with what you paid for it. So you don't know if you're going to make a capital gain. You don't know, dividends aren't fixed. You don't know if you're definitely going to get paid your dividends. With bonds, certainly for the kind of fixed bonds, you or kind of the straights as we might know them, there's a lot more certainty in terms of the returns from your investment. You know what you're going to get. second thing there is that, again, along the same lines, most of them will have some of them will have fixed maturity dates. So you know when you're going to get the nominal value, the amount that you have lent paid back to you as the bondholder. So again, there's some certainty there for you. So it links in with that first point. And then you've got a range of income yields. So, you know, lots of, as Arjun was saying, lots of different bonds that you can invest in. So you've got choice there, which is quite nice. And again, you've got similar with equities. You can look at different companies in different industry sectors. But again, you've got a range of different income yields that might suit. And we've got their different investment and tax situations. And then finally up there, we've got around the security. And as Arjun was saying, the point to kind of bear in mind here is that you're not always going to get 100% of your money back if something goes wrong. And that's quite an important point. But ultimately, with a lot of them, there is security there, whether that's in the form of a third-party guarantee or, as Arjun was talking about, covenants. We're also been speaking about credit rating agencies and the fact that you've got a third party that sits there and actually looks at these bonds and says, right, we take into account X, Y, and Z. We think this is rated as A, B, C, or whatever that might be. So there's almost a comfort blanket there for a bondholder as well to know that when they invest in that, that actually there's a bit of kind of peace of mind that they know that potentially there's less risk or more risk that they might lose their money or not get all of their out back. Go on, Arjun, sorry.
Just to pipe in very quickly, Matt, I promise. Fixed maturity date is useful generally for a lot of like institutions, for example, pension funds. You know, you've got a liability that you need to pay in 5-10 years time. You know, that's a fact. You can buy bonds which will mature with that same value in 5 or 10 years time. So you're kind of matching your receipts with your liabilities. Or you might look at it like, for example, a lot of our clients are, you know, in their 70s, they're retired. They want a fixed income stream so that they can pay their bills, so that they can, you know, keep the lights on and kind of just have that income stream kind of guaranteed and secured going forward. There are a variety of reasons why these particular features are really useful, not only to individuals, but a bunch of big institutions as well. I would also say another advantage of bond investing is diversification. You know, equities will perform well in certain environments, bonds will perform well in certain environments. It's great to have a portfolio with a mix of both so that you can kind of take advantage of the relative diversification that they give each other in the same portfolio.
Excellent. Thank you very much, Arjun. I appreciate the extra information there. You're absolutely right. Yeah, really good point. So they're the advantages of investing in bonds. Now, in terms of the disadvantages, we've got a few more here. The things to kind of bear in mind. Something that can impact upon the real value of the bond is inflation. Arjun was there talking about, you know, bonds being used in pension for those retiring and things like that. Talking about pension funds using bonds, and we've spoken, I think, in one of the previous sessions about index-linked bonds that might be, or inflation kind of busting bonds that have nominal values and coupons that vary with inflation, so it protects them against the value of that investment being eroded over time. So this is a risk. So if you've got a bond that it's got a £5,000 nominal value and it doesn't mature until 10 years, when you get that £5,000 back, that £5,000 in 10 years won't go as far as it would have done when you originally bought the bond because of inflation. So some bonds are issued that and have the ability to guard against or mitigate that risk. So it's important to bear in mind there. And again, Arjun, if there's anything that you want to add to any of these, please do. Just say. The other thing there is price risk or market risk. So the fact that we've spoken previously about how interest rates can, if a bond is going to be traded before it matures, It may influence the price that that somebody may pay for it on an exchange. So again, interest rates can have that influence over the price of the bond, and therefore the price can go down and it can go up, which obviously would be a positive, but actually it can go down. So that again can be a disadvantage if you're looking to trade a bond, but that might work in your advantage if interest rates go the way that you might like them to. You've got the default risk, which we've spoken about when we spoke about security, and about the fact that a company may end up being wound up, or something like that might happen, and therefore a company might not be able to pay, or even a government for that matter. There have been numerous government defaults for countries over the years, with governments not being able to repay their bonds. I think when we started the program, we were looking at some of these things. Argentina, it was another couple of countries. I think there was something. Is it that they call them is there 6 of them, or there's something like that, countries that have defaulted a certain
a lot in South America, African nations as well. Yeah.
Right. Yeah. So again, you have to be wary of that risk. And as we were talking about, the risk that's posed with that bond, you should expect to see higher coupon rates with those bonds, but obviously there is a higher risk that you could lose some, if not all, of your money. So just bear that in mind. That is a disadvantage. And obviously, we're looking at equities. You have a similar issue with companies. A company could go under, and therefore, at least a bondholder actually, in many respects, is slightly better off because they're more likely to get their money back, as Arjun was saying earlier, in terms of kind of the seniority of a bondholder over a shareholder. So an important factor to think about there. And actually, funnily enough, seniority risk is another disadvantage that may come with bonds. And Arjun, at the start, you were talking about how within bonds, some may kind of be higher up the list in terms of when they're repaid to bondholders if a company, something happens to a company or a government. So there is this kind of hierarchy sometimes with certain bonds. Some have clauses in them, don't they, that mean that they are paid back prior to any others. Is that right?
Yeah, correct. And also I would say some companies are organized with specific structures which they issue bonds, and so those structures will have a particular hierarchy in themselves. So it'll be like a flow diagram essentially that you'll see, okay, these guys will go first, then this guy, then this guy. Yeah,
interesting. So basically always check where you sit in that hierarchy in terms of when you might get your money back. Yeah, so there is this seniority risk. So not all bonds will be paid back at the same time if something happens. It could be that bonds are ranked or sit further up that hierarchy in terms of when bondholders would receive their money back, if they do at all. We've got in here exchange rate risk. So if you're buying bonds denominated in currencies outside of your domestic currency, again, fluctuations in values of those currencies may have a detrimental effect on the value of your investment with these. Is there anything that you want to add to that, Arjun, around exchange rate risk? Is that something you see quite a lot of, or encounter quite?
So it's something that can be easily hedged for us. When looking at bonds on a big portfolio like ours, it's very easy to, we have mechanisms that hedge out any exchange rate risk. So we are primarily a GBP sterling fund with our main fund, and all of our exposures are hedged back to sterling. So we essentially, you don't want your bond fund to be essentially an exchange rate fund and just going all over the place. So it's important to minimize that risk. Yeah.
Okay, great. And just to clarify on that, Arjun, so how would that, in terms of hedging that, what would you just have cash in?
Sure. So let's say I bought $1 million bond and it's going to mature in 1 year. So I'm going to get $1 million in 1 year. I can enter into a contract today for 1 year's time, which will say I'm going to give you $1 million and you're going to give me 800 grand. And that's locked in today. So that won't vary. I'll definitely get my $1 million and I'll definitely get my 800 grand for it. So you've kind of eliminated the exchange rate risk there. And we'll enter into those contracts with banks and stuff like that.
So you're referring to entering into derivative contracts with on.
Correct. Yes.
Yeah. Okay. Well, that's great. The reason I say that is because we cover derivatives after this, so that's that.
Sure.
It's
So
a nice segue.
FX forwards, it would. So yeah, FX forwards is what we use to hedge out that risk.
Okay, great, excellent, interesting. Right, so foreign exchange forwards, and again, we'll come to forwards in the next session. So we'll look at start looking at derivatives then. Excellent, thanks, Arjun. That's why I thought I'd just clarify that, because that gives us a nice segue into what we're doing next time. And then finally, you've got that kind of liquidity risk around the ease by which a bond may be turned back into cash. So again, some bonds are more easily sold at fair market price than others. Is the point that we're making there? Before we
That's
move
probably
on,
one of the more unique things. Sorry. With bond investing, it's probably one of the more unique things that it's not all. I can go onto a website and get access to the FTSE and say I'm going to buy, £1 million of Apple shares. In this case, if we want to buy a bond, we still have to get on the phone and speak to a dealer at a bank and say, quote us a price to buy, $200 million worth of Apple bonds, and they'll come back and quote us a price, which is a unique aspect of the bond market, which you don't get with the equity market. And that, generally with equities, it's very, fast and instant kind of transactions.
Yeah, sure. Excellent. Thank you. Right. So that kind of concludes the advantages and disadvantages of bonds. So the final thing that we wanted to have a look at was leverage. Now, what I'm just going to show you here. So leverage is the term that's used to talk about, and Arjun's alluded to this a little bit as we've spoken through. It's about the proportion of debt that a company is financed by compared with the amount that it's financed by in terms of its equity. So we're referring to how debt can be used to kind of enhance gains to shareholders. And bonds and debt are used to be able to do that. And interestingly, Arjun used an example talking about a company that may be primarily capital structure in terms of its debt compared with its with its shares, and there are reasons behind why companies may want to do that. But Arjun, is there anything that, in terms of, we're going to look at a kind of example of leverage and how it works, but is there anything that you want to add to what we're discussing here?
Sure. I think every company has an optimal mix of debt financing and equity financing. Essentially, what we refer to as the weighted average cost of capital for that company, which is it's the blended rate. It's a blended cost of capital, essentially, which depends on how much your equity costs, how much your debt costs. So there is an optimal value for each company, depending on how expensive it is to issue debt and how expensive it is for them to issue equity. And so it's just about getting that proper rights from those companies.
Okay, right, brilliant, thank you. So in terms of kind of how leverage kind of benefits and hinders shareholders, we're just going to kind of show you how leverage can kind of work, giving an example. So just remember that, again, leverage is this proportion of debt finance compared to equity finance in a company. So this example we've got here, where we have we've got a business that it's a company that's valued at £100 million at the start of a financial year, and by the end it goes up to being worth 120 million. Okay, so the outcome for shareholders will be dependent on how that business's finances or capital is structured. So if in the first instance we look at the company, if it was funded 100% by the issue of shares, 100% by equity. So at the start of the year, 100 million is issued in equity, and that's the value of the company. And at the end of the year, it's gone up by 20 million, so it's now worth 120 million. So that means that you've seen a 20 million pound increase in the value of that equity in that company. Therefore, the shareholders have benefited from a 20% gain in their investments. So all of that 20% gain will be for the shareholders. Okay, so the share value would have increased by 20%. Shareholders are going to be happy with that. Okay, so if we then compare that to a scenario where a company is no longer 100% funded, or its capital structure funded through equity, but actually there's a combination of equity and debt, which could be bonds, then the outcome is slightly different. So again, if you look here, we've got 100 million at the start of the year, but this time we're going to split that 50-50 between bonds and equity. So 50 million pounds of the company is funded by equity, 50 million pounds funded through the issue of debt, borrowing, bonds, whatever that might be. And then we've got the same situation that the company then is valued at then at 120 million. Okay, so the value of the company goes up. So what we're actually seeing there is, instead of a 20% increase for shareholders, we're actually looking at a 40% increase in shareholders, because although the value of the company has still gone up by 20 million from 100 to 120, the 20 million increase is now as a proportion of the 50 million in equity, not 100 million that there was previously when the company was fully funded 100% by equity. So 20 out of 50 as a fraction, if you work that out as a percentage, is 40%. Therefore, shareholders have seen an increase in their investment by 40%, but the company has gone up by the same value as it has in the previous example. But what's happened is, because 50% of the company is financed by debt, by borrowing, this means that suddenly the gains for shareholders are magnified, because suddenly we've got a 20 million increase of 50 million worth of equity rather than 20 million of 100 million pounds. So we're seeing a 40% increase for shareholders rather than a 20% as we saw in the last example. And that's because of that borrowing there that's being used to, as we say, leverage up the value of that company, and therefore all of the gains will go through the equity, because that's the only thing that's going to go up in value, and that's what the company is valued on. But because the equity is now 50, not 100 million, we see a bigger proportion of the increase in value go to the shareholders. So we're looking at 40% increase. So what we're saying there is that if the company uses debt to leverage, in this example here, it actually magnifies the gains for shareholders. So they will actually benefit as a result. Anything, Arjun, is there anything that you want to add to what we've just spoken about there?
No, I think that's a great example, and I guess you'll continue on with the adverse scenario as well, right?
Yeah, absolutely. Yeah, so the key point to say here is that companies that use debt, as well as being funded through equities, through shares, in good times for the business, gains are magnified for shareholders. So it benefits shareholders. They see more of an increase in the value of their investments. But when we look at the flip side of that, where what happens if the value of the company goes down rather than up, then we see a slightly different result. So again, if we say, use the example that first off, that a company is 100% funded or structured in capital structure in terms of equity. So the whole company is valued or structured in terms of shares. Okay, so this time, instead of the value of the company going up, it's gone down. So it started at 100 million at the start of the year, and then at the end of the year, it's gone down to 90 million. So we see a 10 million pound or dollar, in this case, reduction in the value of the company. So 10 million is, as a percentage of 100 million, is 10%. So we go from 100 down to 90, decrease of 10 million dollars in its value. That's a 10% decrease in the value of the investments to shareholders. Okay, so we see 10% reduction there. If we then change that, so the company is again 50% funded through equity and 50% funded through debt or borrowing, the value of the company goes down by the same amount, 10 million. So it goes from 100 down to 90 at the end of the year. What we then see is that the 10 million as a proportion of the equity, which is 50, not 100 now, suddenly becomes a 20% decrease in the value of those shares for the shareholder. So that has when you are using debt to leverage your equity, what you see when a business is having less than positive results and not doing as well as it would have done, and actually we're seeing a reduction in the value in terms of the shareholding, what you actually see is those losses magnified to shareholders. So whereas before, when the company was doing well and the value of the company was going up, the use of debt to leverage equity was actually a positive for shareholders. The reverse is true when the company isn't doing as well financially and that the value of the company has dropped. We actually see that when a company uses debt or borrowing to leverage equity there, so there's a combination of equity and debt being used to fund the company, then you see the losses are magnified for shareholders. So it's good when times are good for the company and profits are going up and the company is increasing in value. But when things aren't doing so well for them, we see that the losses are magnified for those shareholders. And you can see that from using this example here. Arjun, is there anything that you want to add to that at all?
Yeah, I mean, just leverage is a very powerful tool in which to kind of enhance returns, as you're showing, kind of either up or down through borrowing. I think it can be very useful, but it can also be kind of incredibly risky. I don't recommend everyone to, take out a bunch of margin lending and going to buy Bitcoin or whatever, like a lot of people are doing at the moment. But it's it can be a very, very useful tool as well. So it just needs to be used kind of in the right proportion.
Yeah, absolutely. It's getting that balance right, isn't it, for companies? You said some companies will take the view that we'll just laden the company with debt. We'll borrow, and then other companies may look at things very differently. I sometimes use the example of sort of pharmaceutical companies that where they do a lot of R&D and income might be uncertain, things might not work so well. They may be more structured more heavily towards equity rather than debt because of the uncertainty that they have there. So therefore, they don't want all of these regular debt payments when the things that they do as a business are quite risky and may not always come off. Are there any examples? Sorry.
I was just going to say, I think a lot of business owners also want to retain a lot of equity in their business so that they can take share of the profits, right? I mean, the more you give away of your business, the less ultimately you're going to have at the end of the day. So a lot of kind of, visionaries or people who really believe in their business and believe in the brand value and the kind of ongoing, it makes sense to kind of capitalize through debt because you'll retain your business at the end of the day.
Yeah, absolutely. Yeah, really good point. Yeah, really good point there, Arjun. Okay, excellent. So that brings us to the end of the session. There, if you're on the Google Classroom, there is a multiple choice test that you can take on what we've looked at here: security, credit rating agencies, advantages, disadvantages, and leverage. And that kind of brings us to the end of everything that we needed to look at and the content that's included in chapter 5 on bonds. Just leaves me to say, Arjun, thank you so much for joining us here and giving us your insight. It's been really fascinating hearing from you and really useful to get some additional information and context around some of this stuff and somebody that works with it all of the time. So thank you so much.
No, thanks, Matt. And if anyone needs any more information or bonds or the fund or anything, just look us up on the internet and happy to help.
Thanks, Arjun. That's really kind of you. Okay, we'll see you for another session next time, everybody. We'll be looking at derivatives, so we will start looking at that in the next session. Thanks very much.